Okay, so I print out the latest slides that I updated yesterday in the evening because I had a conference since last Tuesday and all the way to yesterday morning. I wasn't in the office until 10 a.m. in the flight from United States directly to Melbourne. During the conference, I made an update on the lecture 9, and then the lecture 9 notes has been updated last night. And I know many of you don't have enough time to print it out, so I printed out 100 plus copies, hard copies for today's class. So everybody can get one copy here. First come, first serve. Just take one copy, no more, because I guess maybe there are more than 100 students who are going to present themselves in their class. So don't take extra copies because students can always access the online copy. This is just for those attending today's class but don't have enough time to print it out. Okay? So let's start from this. Do this again. Just don't take more than one copy, okay? Well, I imagine. So for students don't have the hard copy of this one, please raise your hand. I just want to make sure everybody has a copy for today's class. Everybody got a copy? Okay, let me know. 2, okay. I don't know whether it's enough copy. We have 300 students in total. Okay. Let me know if anyone doesn't have a copy of today's lecture notes, which I printed out last night. If you, okay, so 2 more copies, right? Everybody got a copy? Everyone has a copy? Everyone already got a copy? Okay, that's good. Okay, so why I have to do this today? Because this is a very important chapter in finance. If you talk about the theory, this is one of the 2 most important theories in finance, in academic finance and also practical finance as well. I told you that the other one is, of course there are many other important theories, but there are 2 basic fundamental theories in finance. Let's say the broad area of financial economics and with a focus on finance. One is capital structure, and the other one is in assets pricing. Assets pricing, the most important one is mean variance, which we have already covered. And next one, if you want to move to the assets pricing, that would be the CAPM. Yes, please. Yes, just yourself. And the students, you don't get a copy? Yes, please. Mean variance, that's the first one. CAPM, that's the second one. And we usually compare the mean variance and CAPM all together. That's build up the building block for the assets pricing. And if we keep moving up, then we can have Black-Scholes model in that direction. But that's in asset pricing. And in the corporate finance, Modigliani-Miller theory is probably the most important one, the most fundamental one. This one, the theory, in order to fully appreciate the theory, this is based on my experience. When I look at it again, so what you have, the slides in the last, it's dated on 13 September. It's when I first look at the slides, they are good slides based on the textbook. But when I have the experience talking to some of the students in this class, I understand this is the first year MBA class, at the first year corporate finance theory in MBA level. I realized that my experience and my fellow students' experience when I was MBA students. So I noticed that there is some, let's say there's a gap between how the textbook want to push the theory and how the students at the MBA level, especially at the general MBA level, could appreciate those theory. There's some gap over there. So in order to improve the teaching efficiency, which is we try to present difficult material as simple as possible, as easy to accept as possible. So that's the motivation I try to revise and update the slides by myself. Last week I was in the United States for a conference. So after the conference, early morning before the conference, I spent some time to revise the slides page by page and even do this on the airplane from Los Angeles to Melbourne yesterday. It's 15 hours, more than 15 hours flight. I spent 2 or 3 hours working on this. I took some sleep, watched some movies, and that's how I spent that 15 hours. So yesterday I had a meeting with the department chair, and after that I spent another 4 to 6 hours, revise all the rest of the slides, and the last night at 9 o'clock I printed everything out. If you check the time that I uploaded the slides on the internet and the Moodle, it was 8:35. After that I spent 30 minutes to print them out. So that's where we are. Let me know how do you like these revised slides, because I think this one is I take the theory So my understanding is I have some experience as a financial practitioner in the practical world. Then I switched to the academic area. The first degree I took on purpose is an MBA degree. Then the MBA degree, I go to the PhD degree. So my experience with Modigliani-Miller theory was both I was in the MBA student and the PhD students. Once I then was a researcher, I was trying to understand this theory from a different perspective. So yesterday's the updated slides is based on my experience from all the three levels, MBA, PhD, and the researcher level. All these I understand in three different levels, and I try to think this theory from a perspective that first year general MBA students, how they are going to understand this. So this is only from my perspective. Let me know whether you can understand this in the same way as I expected, okay? It's basically whether you understand the theory in a good way. So that's all my introduction for today. So let me do the theory. Okay. So this lecture is about capital structure. But the first question the student may want to answer is, hey, you're going to spend another 3 hours talking about this lecture. Why this is important? And why we care about capital structure? That's the first one, very intuitive. And the answer to that is also very simple and straightforward. Why? Because firm value is very important to entrepreneurs. So entrepreneurs, why the MBAs care about? Because many of the MBA, the career of the MBA is try to be one of the entrepreneurs and great entrepreneurs. And one of the most important questions entrepreneurs want to answer is try to enhance, increase, enlarge the firm value, right? So the firm value is very important to entrepreneurs. And most firms started from equity finance. Equity finance. If you are small, if you are young, you don't have any reputation, how can you borrow that in the market? You cannot borrow. Most of the firms cannot borrow. Then some of them may say, oh, how do we understand in the recent years there are so many venture capital? Yes, venture capital is exactly for equity finance. It's for the equity finance, not for the debt finance. So when the firm can start with debt finance, it's when the firm has grown up a little bit older for a few years, when they show some tracking records that either they can make profit or they show the potential to make profit in the future, that's the time where a bank can loan the money through the debt market. That's what we call external debt financing. Okay? So as firm grows, no equity financing resources gradually become available. Gradually become available. It's not jump into just one start. It has to be started gradually. You have to either to show that you have made some profit, that you can pay back the interest rate, or you have to show the potential that you are going to pay back. Okay? So an important question is, given the constraints of available financing resources, whether and how the entrepreneurs could maximize the firm value by applying different mixture of debt and equity financing. So what does this sentence say is, we're living in a world with the boundary of the resources we could apply. We all live in a world with a boundary. And for the entrepreneur, the most important boundary is capital constraint. You have the constraint. You don't have unlimited budget to do whatever you want. Basically, you have the constraint. Of course, you have a time constraint, you have a family constraint, but for the entrepreneur, you have the capital constraint. That's the most important thing for your ambitions. So within this constraint, how to maximize the firm value? Through what? through the mixture of debt and equity financing. So the question here boils down to whether an entrepreneur could increase the firm value by just adjust the capital structure of the firm. So you may want to understand what exactly is capital structure. So we have the definition here, is the capital structure is a mixture of sources of funds used by a firm to finance its operation and or, I should say and or, because some firms and or investment activities is called a firm's capital structure. So basically, capital structure is kind of financial resources. So why you need the financial resources? Because as an entrepreneur, you want to produce something. You want to make some contribution to the society. How do you make those contributions and produce those things? To operate that's how you generate operation income, right? And to invest in operate your current projects, invest in new projects. So that's the activities you're going to do. And this mixture of debt or equity or both, or including either common equity, that's the most basic fundamental elements in the capital structure. It's almost every firm started with equity financing. Okay, so the equity could either coming from entrepreneur itself or coming from, say, venture capitalist. And someone, when they see the venture capitalist, they may have another question. So why the venture capitalist want to give the funds to A and not B? How do you get this? Why the venture capitalist want to give the funds? We see Wall Street newspaper titles, this ABC or Alpha company get $6 million from the venture capital, from the Silicon Valley. Why they can get that? So we talk about the two conditions, right? If you want to get the money, if you can get the money in the market, either you have to show that you have made some profit in the history. That's the first one. And the second one is what? You can show people that you have potential to make money in the future. That's the second condition. Okay? So if those companies can get the venture capitalist the funds, it's most likely this individual has shown some tracking records in other company that they made profit before. Okay? And so everything started with equity financing, even from the venture capitalist perspective. But once the firm started growing, they started to consider other external financing resources. What kind of other external financing resources? Debt, for example. Then the students may ask, since we already have the equity financing, why I care about debt? Why? Well, that's one way to think about it, but that's another. Think about how we, as an entrepreneur, if you have equity financing, think about that's the benefit you got. Somebody give you the money, and it becomes equity, and equity has a cost. So we need to compare the cost. And once we compare the cost, then there is a number one criteria into the consideration, which is what? If its cost is too high, I try to switch to low-cost financing, right? Debt financing, it's the lower cost than equity financing in most cases. Okay? So that's why they have to pay that high price to get started. Once they get started, they can gradually lower their cost if they have a good tracking records. Okay? External debt financing. That's the one to switch from equity financing to debt financing. So of the firm a firm has a few years of experience in the market by showing their tracking records in terms of profit making, market share domination, and so on and so forth, in terms of making money, contribute to the society in the future, then the firm is able to show the people that they could switch to lower cost of financing, which is debt financing. That's the second bullet point here. A debt of a company can either be long-term or short-term, secured, unsecured, convertible or not convertible into the ordinary shares. So for this bullet point on, we can teach a new unit. It's called a bond fixed income market analysis, which I taught before. So it's a unit. For these bullet points alone, we can develop a new, the unit, of course, teaching whole semester. And actually, the knowledge within that bond market, for example, swap and the repo, we can teach like 3 weeks the course, 2-3 hours for each week, and for that one. And in equity finance, we can either have preference share or common share. That's two most important ones. And the common share is far more important and popular than the preferred share or preference share. So that's two basic types of capital structure: debt financing, equity financing, debt financing. Since we know that debt and equity are both available resources to finance a firm's investment operation activities, we need a kind of measurements to measure the so-called mixture. And this is quantitative. It has to be quantitative. Why? Because we are in finance. So basically in finance, everything could be and should be quantitative. So how do we measure this mixture? We use a jargon or terminology, whatever you want to call it, is a financial leverage. Financial leverage. Okay, for those students just come in and they're without a copy of the hard copy that you're going to see, please raise your hand, please. Okay, 1, 2, 3, 4, 5. Okay. Would you come to me? It will be much easier because the classroom is a little bit large. If it is not coming in today's class, I will not. If it comes in today's class. Okay, great. Because I only print out. So everyone has a copy right now? Because once I made those slides, it's very easy. When I'm making those slides, so when I'm making those slides, I keep mocking presentation in my mind. When I'm making them, I say whether the logic is going to very smoothly, how the students is going to accept this. I'm thinking all the questions. So I want you to, so for these slides, if I present in this way, I think it's much easier for students at MBA level could get accepted. That's how I want to pitch the story here. I like this serial very much, for example. So let's go back to this one. Once we understand the financing resources could come in from either equity or debt, external debt, in the two big categories, and within equity we have common shares, preferred shares, that's two most common subcategories. Within debt category we have bank loans, corporate bond, and commercial paper. And within all these, we can further spread them short-term, long-term, convertible, not convertible. That's another category. Then we have to give everyone a quantitative measure why the capital structure of firm A is different from capital structure of firm B. Why we want to do that? Because once we could quantify the capital structure, then we could say, let's look at this capital structure, for example, is represented by a number, and how that's going to affect the firm value, right? Because the ultimate goal as an entrepreneur is try to maximize the firm value. So that's how we want to do it in this way. So the measurement that we want to introduce here is the leverage, or financial leverage. Okay, in short, it's the leverage here. You see that leverage here? Yeah. So the leverage definition it's a little bit loose, as you can see here. It's the fraction of total financing that is represented by debt. The leverage is a measure of the firm's capital structure, and a higher fraction of that in general indicate a higher degree of financial leverage. So there are three common measures of financial leverage in the academic and the practitioner world. We can either use debt versus equity. We can also use debt versus total assets. So what is total assets? Total assets is equal to debt plus equity. Okay? That's that. And we could also use the interest rate coverage, which is earning before interest rate and tax divided by the interest rate per payments. So think about this. There are measured in three different ways. First two, more or less, is in the broader definition of the capital structure. But the third one is a little bit narrow. It's generally say that you have earned all this, EBIT. This is how you earned in this year, because we calculate the EBIT. We can calculate it in each quarter. We can also, more commonly, we can calculate on an annual basis. Each year, this is the earning you have earned before interest and tax, and this is how much interest rate you have to pay for the debt you have already borrowed. And then there should be more than one. This number. And if this is less than one, the firm is in big trouble. Okay, I see at least one student was there. Yes. So let's go back to the fundamental question we started in the first slides. Once we have all these definitions. So how to maximize the firm value? To calculate how to maximize the firm value, we need to understand how to evaluate the firm value. Okay, back to the very basic formula that we have learned before. Firm value is discounted future cash flow in the future. That's the basic definition, right? It could be firm value, it could be bond value, it could be any financial. Think about the entrepreneur is just another project we're going to do. Entrepreneur or the firm is going to generate a bunch of cash flows in the future. Then in order to get the value, the current value of the firm, we need to discount the cash flow generated in the future. Back, we sum them up. Then that's our firm value or project value. So a cash flow and a discount rate. Therefore, in order to increase this one, you want to increase the firm value. What you could do is you could either increase this one, right? Or decrease this one, or both. Right? You can do this one. So that's two possible strategies. Now let's get down to the question. Can the capital structure by itself help the entrepreneur to achieve this goal? And if it can, if yes, how they can do it? That's the question we want to answer. Then that's going to cut into the theory that we're going to discuss today. It's Modigliani-Miller theory. Okay, as you can see here, the paper originally published is Miller and Modigliani. But later on, we flip up, say Modigliani and Miller theory. The paper published in 1958, The Cost of Capital, Corporate Finance, and the Theory of the Investment. The two co-authors made two propositions regarding the capital structure and its effect on the value of the firm. So the question is very narrow and cut into the basic, is whether the capital structure is irrelevant, or in another word, could helpful to change the firm value. And the answer from this paper is, well, the answer is no. But it depends on three conditions. What's the first condition? There is no corporate tax over there. A second condition, there is no information asymmetry or transaction cost. You can add information cost. There's another word. There is another word. Use our academic word. It's asymmetry. Asymmetry. A-S-Y-M-M-E-T-R-Y. Asymmetry and the transaction cost. And the third one is the capital structure by itself could not change the real investment policy. And if we're living in a world with the three conditions, then the capital structure doesn't really matter in terms of deciding the firm value. So that's, the capital structure is irrelevant to the firm value. How to understand that? I'll show you a three pie chart here. Think about the three firms here, or a firm that they could change, if we could change the capital structure in three different forms. In your left-hand side is all equity financing firm. All equity financing firm. That's totally blue. On your right-hand side, there are actually your two in the middle, and the right-hand side there basically is a mixture of equity and debt financing. But the mixture is kind of different. On your right-hand side, that debt has a higher value than the equity. And in the middle, equity has a higher value than the debt. But if we live in a world of Modigliani-Miller theory without corporate tax, without transaction and information asymmetry, and the capital structure decision does not really change the real investment policy of the firm, then we can say, regardless of the capital structure in three different forms, the left-hand side, in the middle, or on the right-hand side, the firm value are the same. Are the same. So that's what the firm value of the 1 and 2 and 3 are really the same. So how do I understand this? Well, I already said that conclusion here. And next one is we try to show the first one, the ABC one. You see the simple example of the ABC firm and the 1/3. This is the example I want to show you. And then I give you a semi-academic proof, okay? Because it's a theoretical course. It's a theoretical lecture. So we started with an example here. All are with numbers. It's not that dry. It's going to let you to thinking about without the numbers. Let's start with a very simple example. Before we start the example, we need to understand a few terminology here. Is we define firms with equity-only financing. It has to be equity-only financing, are referred to as unlevered firms. It's full equity, which is a definition. No leverage, unlevered firm. And a firm with a mixture of equity and debt financing are referred to as levered firm. Firm with leverage, referred to firm has debt financing. That's our terminology, okay? Levered, unlevered. Unlevered, full equity financing, whole equity financing, equity-only financing, firm without debt. This is how we refer to on the unlevered firm. Levered firm means with firm with some debt, at least some debt over there. Suppose the ABC is an unlevered firm or financed entirely by equity, and you are the only shareholder. So I give you a very, very simple scenario, okay? Under this scenario, simple scenario, let's see whether the capital structure could change the firm value. And the firm generates, let's say, the annual and the perpetual cash flow of $100. Why I want to use the perpetual? Because that's another assumption that I want to make things easier. Once we could use the perpetual cash flow, then we can use a very simple value formula to discount all the future cash flow into the present value. That's in the next bullet points here. And if we assume that the discount rate is 10%, so the value of this company would equal to the value of the firm is equal to the future constant perpetual cash flow in each year, discounted by its discount rate. Okay? They should be the firm like this. They originally should be like this. It's equal to cash flow 1 discounted by 1 plus 0.1, right? That's the first year. And the cash flow 2 discounted by 1 plus 0.1 to the power of 2. And you need to go all the way to what? To cash flow infinity. And divided by 1.1 to the power infinity, because that's perpetual. And once we get everything, sum them up, and the result is equal to this one. That's how we get the perpetual. And in today's class, we're going to assume this perpetual cash flow in most of our calculation, because that's easy to help us discount the future cash flow back into the present value. Okay? In this case, that future cash flow discounted by the interest rate, you see there is no 1 plus here. There is no 1 plus here. Okay? And that's equal to $1,000. That's a firm value. You are the only shareholder. Your firm, you are the only shareholder. The firm generated $100 per year and perpetual cash flow. Your firm value today is equal to 1,000 Australian dollar, US dollar, whatever you want to use the unit. Okay? And since the company is financed entirely by equity, then the value of the firm, because that's an equity firm, is equal to 1,000 as well. So the firm value is equal to equity value. That's all we have. Now let's assume, because you're an entrepreneur, You want to increase your firm value. And somehow you want to increase your firm value, and you boil it down to the question, if I change the capital structure, would that be possible to increase the firm value? So you want to change the capital structure from equity finance only or unlevered firm to equity and debt financing or levered firm. We can take any examples, but let's say an easy think about. An easy example is such change is that a company right now is not financed by $1,000 of equity. Instead, the firm right now is financed by $800 of equity plus $200 of debt. So in total, they're still financed by $1,000. To achieve that goal, the company could do that is to issue a $200 perpetual bonds. Again, let's assume it's a perpetual. Okay? Perpetual bond, assume once you issue the bond, you have to pay some interest to the investor. Let's assume the firm is going to pay 5% interest rate. And because the firm issued 200 bonds, so they could use that bond proceeds to do something. So what the firm is going to do is, by issue that 200 bonds, the proceeds is going to pay as a dividend to the shareholder. Okay? So the shareholder receives one-time lump sum dividend. And because you're the shareholder, you have received this one. You are the only one who received this one. After you receive the $200 proceeds issued by the company, the capital structure has changed. Right? The capital structure has changed. And because of the change of the capital structure, it also changes how much cash flow you received from the company. Why? Because right now, you do not receive $100 anymore. Why? Because the company by itself still generates $100 cash flow. That's coming from the operation activity. The operation activity of the company generates $100 each year and forever. That's coming from the operation activity. However, from this $100, the company has to pay the debt holder, because the debt holder buys the $200 of perpetual bond. Has to pay the debt holder how much? Is $200 times the interest rate each year. 5% interest rate, which is $10. You need to pay $10, not you, sorry. The company has to pay the $10 to the debt holder. Therefore, you received $90. Originally, you received $100. Right now, you decide to change the capital structure, and you receive $90. As a shareholder of an unlevered firm before, you received or you owned $100 cash flow each year. But right now, because you changed the capital structure of the firm, you only receive $90. But remember, you are not exploited here. Why? Because you already received $200 upfront proceeds by issuing the perpetual bonds. So that's a trade-off. You issue $200 upfront as a perpetual bonds. You get that cash upfront forever. Then the cost that you are going to reduce the $10 in the future, you discount the $10 in the future perpetually, going to back, and you get $200 present value. That's no arbitrage here. You see, that's no arbitrage opportunity here. So you're not exploited here. you're sort of still not happy. Let's assume that you're not happy. Well, of course, you should be happy, but the reason we said you're not happy is want to proceed the direction you want to change it back. Okay, that's Modigliani-Miller theory is going to tell us. Let's say you're not happy with the $90 cash flow, which you should. But you can't undo this change. How to undo this change? You could use that $200 dividend to buy these perpetual bonds. So you buy back these perpetual bonds. So now you get what? Annually, since you buy that $200 perpetual bond, of course you are going to get the interest rate paid to the bondholder. Right now, you become not only an equity holder, but also the bondholder. You see that? Originally, you are an equity owner of the firm, right? Right now, you as the shareholder, you are both the equity holder and the bondholder. Because why? Because you used the $200 dividend to purchase the perpetual bond. So you are both the bondholder and equity holder. So in your capital structure, your own capital structure, you're level. Okay? And you can see very simple here is the cash flow will be the same as before. Originally, you're fully equity financed. You get $100 cash flow. Right now, you are, as the owner of the company, you're both financed by equity and by the perpetual bond. That's your capital structure. And you get the same cash flow. So as you can see, the change of the capital structure does not really change the cash flow. It is also true if you are not the solo shareholder. And I don't want to push this down further forward. And for any students who are interested in this direction, you could refer the textbook 552 to 553 the page. There is an example over there. You can think about that. Well, this is a very simple example. This is a very simple example. Okay? We have not proved it yet. So let's move forward and try to prove this proposition in a more realistic scenario. Okay. Let me discuss about the proof, the word proof here. In the academic level, we have to prove eventually. We have to prove, okay? That's a major difference between a generalist and academic. Academic, we have to prove everything. The generalist, they have just to tell the story. Academic, we have not only the story, but also show the proof. But the level of proof was different. At the MBA level, we could use some numeric to show the proof. That's probably enough. In the PhD level, most of the proof has to be in a so-called generalized term. So we should use ABC, A plus B equal to C. We could show some of this. We cannot use a number anymore. So this is, I rephrased the PhD level and use some numeric number to show that we can prove this. But there is a key strategy in terms of proof here, which is the same as the PhD level, is we use risk-free arbitrage. Risk-free arbitrage. So what does this mean? This means I'm going to show you, I'm going to construct two types of security here. Two types of security here. And let's say a leveled firm compared to an unleveled firm. I want to prove the leveled firm is the same as the unleveled firm. So what I'm going to do is I'm going to buy a share of leveled firm and sell a share in unleveled firm. Right? And if the value of the two firms are different, I'm able to generate some profit or loss, right? So if after the proof, in the end of the proof, the buy and sell the shares of the two firms, assuming they're undertaking the same risk, cannot generate any profit or loss, then we have to make the conclusion that the two firms are the same value. So that's the basic idea of risk-free arbitrage. This is used very commonly in the academic proof in the top level. Okay? PhD level, researchers level, we have to all use this level to prove something. You give me something, I construct a counterparty here. I do the so-called risk-free arbitrage. I construct that this thing has the same risk profile as the one you give me. I do one sell, one buy. Two firms, two securities, same risk. And if this pair of buy-sell strategy is able to generate some profit, either the profit or the loss, then we have to make the decision, conclusion, the two firm or two security have different values. If in the end, the buy-sell strategy cannot generate any profit or loss, then I have to make the conclusion that the two firm or two security have the same value. So that's a basic idea of risk-free arbitrage. This is used all the level, from the MBA level to the PhD to the researcher level. Okay, so that's especially in the theoretical proof. But right now is I just use that idea and put it into the numbers. Okay, I use the numbers to show this idea. Okay, for any students coming in the past 10 minutes, if you don't have a hard copy, please raise your hands. If you don't, okay, I assume everyone got one. Okay, so we started here. Consider an unleveled firm, which is a U unleveled, generates perpetual cash flows. We're always using perpetual cash flow because that's going to help us to discount the future cash flow back into the present value with a very simple, easy formula. And to make the things slightly complicated, I will assume this firm has 100 shares outstanding, and its cost of capital, let's say, is 12.5%. It's a common assumption. And let's also assume the firm was operating in an economy that could have different scenario. Okay? The firm is working in an economy that could have next year, the economy could be either expansion, or generally okay, or in recession. And I can even sign the probability, it's all the arbitrary probability here. The probability, let's say, 3/8. The probability is in expansion. And a 50% chance was in okay, and 1/8, the probability is in recession. You can think about the first two, but the thing here is that all three, when they add it together, has to be equal to 1. Okay? Recession, the probability of recession, okay, plus the recession, expansion, recession, okay, has to be equal to 1. Because the firm, if it's in expansion, then the firm could generate higher revenue, let's say $300. The firm is in okay. The cash flow generated is slightly lower, $250. And let's say if it is in recession, the firm generates 100, which is the lowest among the three. That's also very reasonable, right? High cash flow in the expansion, medium cash flow when the economy is okay, and the lowest cash flow when the economy is in recession. Therefore, we could calculate the earning per share. So that's going to help you to refresh some accounting measure. How do we calculate the earning per share? How do we calculate the earning per share here? Your earning is $300. You have 100 shares outstanding. You use the 300 divided by 100, you get $3. 250 divided by 100 shares, you get $2.5 per share. And $100 divided by 100 share outstanding, you get $1 per share, earning per share. That's a accounting measure. Okay? 3 different scenarios. Therefore, we could calculate the expected, especially the expected. Okay, let me put there are many, I want everyone to be very comfortable with this one because I think this is first part of this lecture. People are mostly focused because in the end, many of you are worn out, just like me. So that's very possible. We're going to test this in the final. Okay? So everyone, if you're not comfortable with this one, ask your question as soon as possible. I want everyone get very comfortable with this. So the expected earning per share is equal to 3/8 of the probability times $3 plus 50% of probability times $2.5 and 1/8 probability times the $1. Therefore, the expected earning per share will be $2.5. That's also acceptable, right? Okay. And let's just make another assumption. Let's assume all earnings are paid out as dividend. Okay? You don't need to be the only shareholder anymore. I relaxed that. I just assume all earnings are paid out as dividend, and therefore, the firm, the value, would equal to what? So that's going to refer to our what? What we have learned. Firm value is measured by discounted dividend, right? This is perpetual dividend discounted model. We learned it before. So we put it here, as you can see that. So the firm value would equal to the dividend divided by the cost of capital. That's for share, and then we times 100 shares, then the firm value is equal to 2,000. $2.5 divided by 0.125, which is cost of capital, times 100 share outstanding. Therefore, the firm value is equal to 2,000. And each share is equal to $20. Right? Let's say, right now, we're in an unlevered firm. Let's say someone bought the unlevered firm, and wanted to change the firm's value. Look at the C. It's how I put the word here. It's the one, first of all, you board the unlevered firm. So that means the operation and the fundamental of the firm is not going to change because the same firm, just bought the same firm, right? And I wanted to change the firm value by doing what? By creating a leveled firm. Create a leveled firm, which is, in short, is L, level. And let's see how that unleveled firm could be. Well, there could be any type of leveled firm, but let's assume, again, the leveled firm L issues $1,000 of debt. Remember, when it's fully equity financed, the firm is worth $2,000. Okay? They want to issue $1,000 of debt. And if you issue the debt, you have to pay the interest to the debt holder. How much? Let's assume another one, 10%. So once the firm issued the $1,000 of debt, then without a change further, they could use that $1,000 to buy 50 shares. How do I know it's 50? Because the firm value is $20 per share. You have $1,000 divided by 20, then you know that's 50 shares. So you buy back the 50 shares disappear. Right now, how many shares in this company? 50 shares in the company. Right? 50 shares in the company with what? With equity financing, which is 1,000, and another 1,000 coming from debt financing. So you don't change the total value of the capital structure, but you just change the mixture of capital structure. Leveled firm is $1,000 equity financing, $1,000 of debt financing. Unleveled firm is $2,000 equity financing. The total number is the same. And let's see how the firm is going to pay both the dividend and the interest rate to the investors when the economy is either in expansion or okay or in recession. So the first two lines here are the same as usual. Why? Because you bought the same firm. You bought the same firm. You don't change anything else. The investment decision are exactly the same, operation follow exactly the same procedure, and probably you're going to hire the same managers to do the same thing. And the economy assumption are the same, because that's exactly the unleveled firm. So the probability of the economy is the same, and the firm generated revenue is the same. But what is slightly different here is because the firm has issued $1,000 in debt, and this firm has to pay the interest rate regardless the economy is good or bad or okay. You can see that? It's the interest rate payment is the same regardless the economy situation. Why I want to introduce it here? Because in the very late of this lecture, we're going to introduce bankruptcy cost. Bankruptcy, or insolvency. Another one is insolvency. What exactly is insolvency? Think about this one. From the ex-ante point of view, we can think about the economy is either in expansion or okay or in recession. But in the same year, the economy is either or, not both. Think about the worst kind of scenario. It's in the recession. For this one, the revenue has all to pay the interest rate. How do you pay the employee's salary? How do you pay, for example, the tax? You cannot pay. And what if the interest rate you bought is 1,500 in the same interest rate? So once your borrowing is over 1,000, the firm is literally in insolvency or bankruptcy. You can see that? If the economy is in recession. So this is what we're going to talk about, the use of the cost of use leverage or debt financing in the very end of this lecture. So I want to plant the seed here. Let you see this one gradually is going to grow in the future, becomes a tree that we cannot ignore its negative effect. Okay? But right now, let's keep moving on. Therefore, because the interest rate is paid in this way, interest rate is paid what? To the debt holder. So the earning per share is calculated for what? For the equity holder. So in the earning per shares, we have excluded the interest rate payments, which in the expansion scenario, we have 300 revenue minus 100 interest rate paid. And right now, how many shares outstanding? 50 shares. It's not 100 anymore. Because you issued 1,000 debt and used that proceeds to buy back 50 shares. So share outstanding is only 50. Therefore, the earning per share in the expansion scenario becomes $4. In the same scenario, when the economy is in okay, 250 income minus 100 interest rate payment divided by $50, earning per share becomes $3 per share. In the worst scenario, possible scenario, which is the economy is in recession, the company earns $100 revenue, the company has to pay $100 in interest rate. As you can see here, I'm emphasizing here, is the interest rate payment is fixed, compulsory, regardless how the economy is performing. And that's the major reason for possible insolvency cost for using debt financing. And in this case, earning per share becomes 0. 0. So right now, the firm has been changed the capital structure, but nothing else. It's same thing. It's the same as unlevered firm, except for the capital structure has been changed. Well, if you compare the earning per share of the levered firm, it seems like at least in the expansion in OK, the firm value measured by earning per share is higher than the unlevered firm. You see that? Except for the recession. Recession is $1 less. But in expansion, is $1 more. And in OK, is $0.5 more. Then the one who bought this company, unlevered firm, claimed by bought the company, buying the company, and changed the capital structure, I didn't do nothing else, and I increased the firm value. You see that? He didn't invest any new money here. This is the point. If you invest the new money here, you say you increase the value. That's for sure, it's expected. The change of the capital structure by the new owner didn't invest any more money in there. It just changed the capital structure. Issue the bond, use the bond to buy back the shares. No more extra money invested in the market. And if this could be done, then everyone in the market should follow this one. Right? Right now, it's our job to prove or disprove this statement. It's a statement. Firm value L, leveled firm, it's, let's say very conservatively, is different. The difference could be either higher or lower. But whatever. As long as we find which one is higher, we could buy before the firm becomes higher. So that's our financial strategy. Buy lower and sell the high. Before the company before high. Okay? So it's our job to prove or disprove this statement. So this is our proof. Our proof uses a very classic risk-free arbitrage. Risk-free arbitrage. Okay, the student just come in. Every student has a copy of the slides. Just try to make sure. Because I put this very up front. Even up front, the discussion of the tutorial questions, because I think this is very important. I want everybody get very comfortable on this, because for two purposes. One purpose is likely there's going to be a, in the final exam, we're going to test this. The second one is, in the interview in the future, it's very likely any question could be related to this one. I hope you have a relatively rich image or understanding of this theory. So we're going to do the proof or disprove by the risk-free arbitrage. So before we can execute this risk-free arbitrage, we have to understand how the risk-free arbitrage is defined. So the risk-free arbitrage is, first of all, this is a pair strategy. It's a buy and sell two different securities, such that the risk associated with the buy and sell positions would net out. So the risk about the net buy and sell could eventually be net out. And therefore, the arbitrage could either generate a profit or loss or zero. Okay? For this one, how do we define the buy positions? We define the buy positions as we buy 2 shares of the firm U, which is unlevered, and finance this buy position by borrowing $20 with the same interest rate paid for the firm leveled. This is our buy position. I'm going to further explain why I should consider the buy position like this. What's a sell position? Sell position is I sell 1 share in leveled firm. So sell 1 share in the leveled firm, buy 2 shares in the unlevered firm, financed by $20 borrowed in the market. Someone may argue, why you want to consider this? Because this is a very classic style to generate the risk-free arbitrage. Is you buy position and you finance that buy position with some risk-free borrowing. And then you short sell another position, and then eventually the buy position or sell position should generate the zero profit. And if not, then this one is going to generate huge profit in the future. Okay? So let's see what exactly is those buys and the sell positions. So the interest rate paid for $20 borrowing, because it's 10% interest rate, that interest rate by the leveled firm. So $20 borrowing is going to pay $2, right? Therefore, the cost of buy position, how many shares you buy? 2 shares, right? Each share is $20. If you buy 2 shares, that's your cost to you, which is minus $40. But you borrow the $20 in. So you have $20 cash in, and you pay $20. Therefore, the buy position costs you $20, right? $20. How do you finance this $20 buy? You finance this $20 buy by taking another sell position in the leveled firm. You sell 1 share in the leveled firm, supposed to generate some cash flow. Let's say that the cash flow it could generate, or assume is $20. Therefore, this buy and sell strategy would eventually net out, and ex-ante, this strategy would generate zero profit. For the students just to come in, you don't have the copy of this one. I loaded it today, Moodle, last night. I assume you're going to have, how many copies? How many copies? 2. On the back, you have the copy. You can download from the Moodle now, because it's over there. Or if you want a hard copy, just come here. Let's pass that. So we come to this far. So if a share of the firm L is equal to $20, then the above strategy would not generate any profit or loss. So we proved that change the capital structure cannot change the firm value. But if the strategy could generate any profit or loss, we have to conclude, we have to concede that by changing the capital structure of a firm, someone can really change the firm value. So that's one strategy, prove either A or B, black and white. There's no quibble, no arguments we can present here. So that's a very classic way that in the academic world how we prove things, okay? So now this is, let's see, we take the assumption, right? All the revenue generated by the firm after have to pay the interest rate to the bondholder are paid out as a dividend. So we have to calculate the dividend of these buy positions from the firm unlevered, U here. It's same thing here, the probability here. And for the unlevered firm, you see that $3 expansion, okay, $2.5, okay, recession, $1, are the same. But the difference here is you buy 2 shares. You buy 2 shares, right? So once you buy 2 shares, and all the cash flow are generated to the dividend, right? Then, because right now, there's no debt here. No debt here. All the cash flow generated are paid out as dividend. And these 2, so you got $6, $5, and $2. That's a dividend you can get, or one can get, or any investor can get. But you financed this position by borrowing $20. Remember, you don't have $40 to purchase the 2 shares. You finance this position by first one is borrowing $20, and the next one is sell 1 share in the levered firm. So we come to the first leg. Because you borrow this $20, and the interest payment is compulsory, regardless of economic scenario. So you have to $20 each year is going to pay 10% interest rate. So you have to pay $2, $2, and $2. Right? The interest rate you borrow on the $20 is compulsory. It didn't change. You didn't tell the bondholder, look, the economy is not working very well. I'm a little bit short in my pocket. Can you give me a slack? That's called insolvency. That's called insolvency. That's called bankruptcy. So after dividend payment for this position, you get $4. When the economy is in expansion, you get $3, 5 minus 3, minus 2 equals 3. And when $2 minus 2 is equal to $0. So that's your buy position, the dividend. Let's see the sell position, what kind of a dividend you can get. You take another sell position in the firm L. It's a levered firm. The firm generated revenue as before because even though somebody bought the firm, they didn't change the operation activity. They didn't change anything else except for the capital structure. So the revenue has to be the same. The economy is out of control, and in our world we say this is externality, okay? The economy externality. But remember, the levered firm borrowed has a debt at 10% interest rate. It's a levered firm. And once again, the interest rate for this levered firm is compulsory. It's not a discrete. It's not conditional. The economy is doing well, I pay the interest rate. The economy is not doing well, not pay the interest rate. That's what? That's dividend. That's a major difference between the dividend and the interest rate. If the economy is doing well, the company is working well, you pay the dividend. But regardless of the economy and the company performance, you have to pay the interest rate all the time, each year. And in the United States, you have to pay every 6 months. Every 6 months. Okay? So the 1,000 debt at a 10% interest rate is going to cost the company $100 in each of the 3 scenarios, regardless the economy is in expansion, okay, or recession. Therefore, the EPS that we calculated before has to be 300 in the expansion area minus the 100, and the result divided by how many shares right now in the leveled firm? We only have 50 shares. It's $4, $3, and $0. Okay. Let's erase all these things. Let's look at these core elements here. Core elements here. Look at these buy positions. Look at these sell positions. We're assuming all the dividends are paid out as, all the revenue are paid out as dividend. Your earning per shares are paid out as dividend. That's exactly the same dividend. And one is buy, the other one is sell. You see that? One is buy, the other one is sell. So its net effect here is the net dividend of this pair of buy and sell positions is equal to 0. Of course, we made the assumption firm pays out all the earnings at a dividend, but it's normal. Therefore, we have to conclude what? We have to conclude that the cash flow of the firm leveled are the same as cash flow as firm unleveled. Weighted average cost of capital that we learned before here. This is, I'm going to bring that weighted average cost of capital that we learned in the previous lecture number 7. Remember, I bring the lecture number 7's material back into this one again. Cash flow is the same in terms of the firm-wise. Then weighted average cost of capital has to be the same. Why? Because the cash flow are riskless, generated by the firm asset, and even the asset could be a mixture of equity and finance. Because we use the firm value as the cash flow divided by the interest rate. It's perpetuity. Cash flow divided by the interest rate in the perpetuity format. Cash flow the same. Weighted average cost of capital that we learned in the lecture 7, which has already brought into this one. And the last one is we proved the firm L, leveled firm, has the same value as a firm unleveled, U here. End of proof. Any questions so far? Any questions so far? I want everyone to be very comfortable on this. Everyone has to be very comfortable on this. Why? Because this is important, and we don't have, in the MDA level, we don't have too many lectures to discuss of the proof and the theory. But the proof of the theory is very useful either in the future, in your future's work. Okay? Interviews, someone is going to find a job, you're going to impress your boss, or someone, a very small percentage of the students who are going to advance more in the PhD level, and that's a very normal common language. And that common language coming from risk-free arbitrage is one of the most important tools to prove things in the financial economic world. We use risk-free arbitrage. We prove there is no arbitrage opportunity. We have to conclude the same thing. The two things have the same value. That's any questions so far? Yes, please. The question. Right now, we're going to assume that that is perpetuity. For what? For two purposes. Once that is perpetuity, then we can value the firm by the very simple perpetuity model. Cash flow divided by discount rate, that's a firm value. That's the first one. The second one is, that's a very important assumption. That is perpetuity. What if that is not in perpetuity? That's going to generate some bankruptcy or insolvency cost, which is what we're going to discuss in the very late of today's class. I'm going to show you that later. That's a good question. Yes. Any other question here? I want to keep at least, yes.
You said that if the share cost of the firm L is equal to 20, then the position is you cannot generate any profit.
Right.
Because the value of the firm L should be not equal to 20.
Yeah, that's what we started here, right? We assume it is not equal to 20. If it's not equal to 20, so you buy 220, okay, you buy in the unlevered firm, you buy 2 shares. Each share costs $20. So it's costing you $40, right? And then how do you finance this $40 purchase? Firstly, you borrow $20 with a 10% interest rate. So $20 is going to finance one position. You need to finance another $20 buy. So another $20 buy financed from what? Financed by the sell position of the leveled firm. And if the leveled firm is different from $20, let's say it's $23. So this combined strategy is able to generate how much profit? So you buy $20, you sell 23, you get $3 profit. You see that? If the leveled firm is less than $20, let's say $18. You buy the $20 in the unlevered firm, and you finance this $20 buy with the $18 sell in the leveled firm. What's the profit you generate? You generate negative $2 profit. It's a $2 loss. You see that? So we are using this strategy to show that to force people to make the conclusion, there's no way you can go. Force people thinking, say, hey, here's a buy. I buy 2 shares. Each share costs $20. You need $40. How do you finance this $40? Well, I borrow $20 from the market. That's going to finance the $20 off. I have another $20 cost I have to pay. How do I pay that? I pay that by sell the 1 share in the leveled firm. Let's say the leveled firm is different from $20. If it's different from, either it's higher than $20 or lower than $20. If it is higher than $20, let's use that example, $23 is a leveled firm. I sell 23 and finance this $20 buy, I make $3 profit. If the leveled firm is worth less than $20, let's assume $18. I sell the $18 in the leveled firm, and I buy the $20 to finance the $20 buy in the unleveled firm. I lost $2. So I'm going to either lose or make a profit by this strategy. And then if the results show that I cannot make any profit and didn't suffer any loss as well in the same time, then what's the conclusion we have to make? The leveled firm should have exactly the same value as the unleveled firm in terms of share by share comparison. So that's the way of thinking. I take more than 1 hour to elaborate this one. And for many of you may not have the opportunity to get into the word so-called risk-free arbitrage. I hope this is the first time you understand it, and you understand it in a clear way.
I'm sorry, in page 13,
Yes.
I'm a little bit confused about the interest rate.
Okay.
How did the concept get out? Because you didn't count the interest rate, but you only consider about cost of buy position and a share sale position. So how the $2, the interest rate, how do you count that?
Yes. You buy the $2. Sorry. When you buy the $20, sorry, when you borrow the $20, you don't need to pay the interest rate upfront. Is that right?
We count the two.
No. When you, okay, so you borrow anything from the bank in the first year, the bank just give you the money.
Also, you pay later.
Of course, it's like the bank, like the credit card.
Right now, you don't consider it.
At the time when you borrow the money from the bank, you just get the money. You get $20, right? And when you have to pay the money, in the end of the year, that's normal. But a credit card is different. You have to pay month end. That's credit card company. But for the normal bank loan, that interest rate would be paid either in 6 months, let's assume in the European, it's in the end of each year. It's annual interest rate paid. Let's assume annual interest rate paid. So you don't pay that interest rate upfront. You get the proceeds of $20. And that $20 is going to finance 1 share of purchase of the unlevered fund.
At the end of time.
Yes, that's right.
If you have to sell the share like 22, you can get out.
No, okay, let's see this. When do you pay this one? It's, you borrow $20. No, $20 is interest rate, sorry. This one is calculated, you remember EBIT? Earning before interest rate and tax. I haven't included tax yet. Tax is in after the break. We're going to include in tax. Okay? So right now, it's after 1 year's operation. After 1 year's operation, in the end of 1 year, you need to pay this interest rate. I want everybody to get very comfortable or reasonably comfortable at this one, because you think about that, this is something that could make the student stand out in the future. Okay? This course is taught in every university. I guarantee you. And I think I teach this course in a very advanced way. But reasonably to get accept. Okay? Because normally people, MBA level, unless you are in the option level course, we rarely use the risk-free arbitrage. But to use the risk-free arbitrage, the strategy to prove something, is really, I would say it's a little bit complicated. You want to show people you are complicated, right? You want to show people you are simple on the job market. It's reasonable to understand, but if you have any questions, please let me know. I'm more than happy to explain this. I have the consultation time after class, Tuesday, Friday. Feel free to drop by my consultation time. Yeah, because this is a very good example to show that you can combine, like they mentioned before, that's interest rate, how you borrow this, when you pay the interest rate, we're including weighted average cost of capital into this conception. We're also including different scenario, so we could put expected earning per share. You remember expected return? We taught in previous class into all these example. And on top of that, we prove that by showing this is a risk-free arbitrage. Okay? Any more questions? Yes?
I'm still confused because this slide is proving the dividend does not generate any profits,
Right.
but you didn't prove that the selling and the buying price.
No, because I proved that selling and buying shares in two companies cannot generate any profit, share by share. I proved this. Is that right? I proved this. Share by share cannot generate any profit. Then dividend is coming from what? Dividend is coming from the cash flow. I assuming all the revenue are paid out as dividend. Right? So dividend has been, all the revenue has been paid out as dividend. Right? And in this case, I proved the dividend are the same. So the revenue has to be the same. Revenue to be the same means what? Means the discounted cash flow, discounted rate has to be the same. Because that's weighted average cost of capital, we know that. Right? And because of that, then the firm value of the two companies has to be the same. That's firm value. That's a perpetual discount model. So every step is very classical. Every step is very classical. So this is not exactly my contribution. It's just I got this from Wharton's professors at the MBA's lectures. So I plugged in here. Okay, I made some slightly improvements on this. So yes. Okay, that's a good question. Okay, let me rephrase his question. Why this risk-free arbitrage strategy is constructed by two shares in U, right? And one share in L. Okay, let me tell you this. Let me add one slide here. I'd like you to ask me the question because that's the best way to remember this. Let me get this very clear for everyone, okay? Why we need construct in this way? We want the position to be squared, both ex-ante and exposed. Okay? What's ex-ante and exposed? Before I started the construction, and what's the result of the construction? Before I get started, I buy, don't want to use, I buy 2 shares of U. And how much dollar I have to pay? Cost of $40. I used, cost of minus $40. Okay? I buy 2 shares. How do I finance this buy position? Let me change the way I got this one. How do I finance this $40? Where did I get the $40? This is the idea of risk-free arbitrage. I'm a finance guy. I'm lazy. I don't want to invest anything. So I borrow the money. So this is how the finance is called magic. They try to prove something like this is, I don't invest anything by myself out of my self pockets. I construct the risk-free positions here. What is risk-free? Okay. This is cost. This is my cost, right? Okay. I separate this cost. This is my finance. Okay? Finance. How do I finance in this one? I finance in this one by two positions. A, I borrow $20 at 10% interest rate. That's the first one. There's a B. I sell one share in alpha. How much is the one share? Someone say 20. Someone don't agree with your 20. It says cost different than 20. How different? Either higher or lower, right? Let's say assume it's 20. Assume it's equal to $20. Okay, right now, you compare everything. My buy position and financed by A and B the position together. Upfront. Upfront means the firm's operation has not started yet. The firm operation has not started yet. It's the day that I bought the two shares, and in the same time, in the same day, suppose it's today, Tuesday, I borrowed $20 in the market from the bank. The bank gave me $20 in cash, and I could successfully sell one share of the levered firm in the market. Suppose I can get $20 in cash. Suppose. And we're going to prove has to be $20. And you could argue, no, it's not $20. If it's not $20, give you a number. It's either higher than $20 or lower than $20. Right? And this position up front, it's called up front, in the beginning. In the beginning, total cost is equal to how much? How much? No. Think again. No, it cost $40. You borrowed $20, and you sell another $20 share in the market. How much is the cost to you, the combined? Zero. I say zero. How many of you agree this is not equal to zero? This has to be wrinkled, ironed out. This wrinkle has to be ironed out. Otherwise, you don't understand it says you don't understand the risk-free arbitrage idea here. I say this is a zero. How many of you don't agree this is zero? Raise your hand and tell me why you're thinking that way.
It's not balanced. I think it's not balanced because you borrow 20, so it's minus 20. You sell 20, it's the optic is the 20, so it's zero, and you force.
Okay, let me add one more step. Okay, no problem. Let me add one more step. Let me proceed from A plus B. Tell me how much cash you can get. This is easy to understand. 40, right? This is $40. Is that a plus or is that minus? Plus means the cash coming to you. Minus means get away from you. Is that plus or the minus? Plus.
So you mean you don't have to pay back the borrow
No. Right now, I'm saying, right now, we're in Tuesday. What's the Tuesday? 20th. 20th, right? 20 September 2016. You don't have to pay interest at this front. You borrow the money from the bank. Bank doesn't ask you to pay the interest rate up front. Right? Everyone's comfortable on this. Everyone's comfortable on this. So today, you make 3 transactions. 3 transactions. 1 buy transaction, 1 borrow transaction, and 1 sell transactions. Is that right? Is that right? Everybody has to be very comfortable on this. I think you can get it. And once you can get it, it will be great. It will be great. Yeah. 1 buy transaction costs you $40. Buy 2 shares. 1 borrow transaction make $20 come to you from the bank. Of course, you're going to pay the interest later on, not today, right? And 1 sale transaction, although we don't know how much the price it should be. Some will argue it's higher than 20, some will argue it's lower than 20. Let's assume it's 20. If I assume it's 20, then the proceeds we could get is 20 borrowing plus 20 sold cash proceeds. That's 40 in total. And with that 40 in total, I come to you in a minute. With that 40 cash flow coming to me, I can use that $40 to buy the $40 for the unlevered firm. Right? And by construct this, so this is on 20 September 2000, overall strategy of this is equal to cost me, let's say me. How many dollars? How many dollars? I want anonymous answer. I heard some 0, but the voice is not loud enough because you're not so confident about 0. Has to tell me, if you feel confidence, tell me loud. Anyone is not comfortable with the number of 0, please raise your hand, please. I'm more than happy to go over it again. Because every time we go over, you feel it's much better. This is how we understand the knowledge. Once you feel really better, you are better. Because once you really understand this, you don't need to go back to this. Let me tell you this way. You almost don't need to review this. It's very naturally come up to you in the future. Yes? Cost we're talking about $40, right? It's let me go back because I was supposed to be recording my. Let me go back. So the question here is, he is certain that cash coming to me as an investor, borrowing $20, selling 1 share of the L firm is equal to $40. So $40 come to me is certain. But the question is, it may not be certain, as I have to pay $40 to buy the 2 shares. Is that a question? Tell me why you didn't feel comfortable.
I think the outflow is also 30.
Outflow is 40. It's 40.
And you decide that the cost is 0 and
Yes. The cost is 40, and the income is 40, and you put the $40 coming to me, to the investor. And the investor, in the same time, has to pay 40. So it's 0 up front. Oh, yeah. We're talking about the balance. Yes, we're talking about the balance. You have to net all the things out. You cannot get the thing and take the money, run away, don't pay anything. So you have to, we construct. So basically the idea of the risk-free arbitrage is we don't use any proceeds, money from our own pockets. We don't use any proceeds, and we can buy something. Suppose I have to take $40 from my pockets to buy the 2 shares. This is the risk-free arbitrage's idea. And I want to buy 2 shares. It's called risk-free, because there's no risk, as you can see here. If I take $40 out of my pockets, I buy these shares. And if in the future the shares is going to bankruptcy, that's going to risk to me, right? Right now, how I finance my buy is the $40 buy I finance from $20 borrowed and $20 sold in the leveled firm. So that's how I get the net cost of 0. Okay? One more time. Yes, please.
If I sell the shares in L firm, should I buy it back in a later time? Because I didn't spend any money on buying the share in L before. So where did it come from for me to sell it?
Yes. In the theory, we should. And that's why we have this later page. What I put in front here is on September 20th, today. In the end of this, let's say it's a fiscal year. We have to pay the fiscal year, okay? In the 19th of September 2017, this is my page. This page, you could think about that is on the 19th of September 2017, 1 year later. This is the payoff of 2 companies, including the interest rate you need to pay to the bank. Of course, when you sell the L firm, you can buy it back. You have to buy it back. And in the 2 firms you have already bought in your firm, of course you can sell. You sell that to finance the firm you buy and also pay the interest you have paid for, you need to pay for the bank, loaned you $20. And that's the same thing. Not only the interest, but also the $20, remember. 1 year later, the bond market, you need to pay the interest plus the principal. Principal is $20. Remember? So you sell 2 shares in 1 year. Okay, let me get on this one. Let me get one more page, and I put this page. Okay, so on 19 September 2017, okay, 1 year later, you have to, investor has to unwind. The unwind, I'm going to explain this one. This strategy, right? By doing what? Originally, the investor bought 2 shares. Right? Need to sell, need to sell to shares of unlevered firm. Right? B, pay $20 to bank. This is the principal. This is the all, not all. In addition to what? Interest is how much? $2. You borrow 2 because this is a and plus $2 as IR, interest rate payment. That's not all, right? There's a C here. Because you sell the company L, 1 share, you need to buy them back. Okay? Buy back 1 share in firm L. Okay? Oh, sorry, this is a C, sorry. So we put A, B, C together. You sell 2 shares, it's going to generate $20 times 2. You pay $20. You buy, sorry. That's equal to 0. Is that someone going to ask me where is the interest rate payment? Okay. Go back to the first page. I already paid the interest rate here. Did you see that? The yellow, the blue, the red circle here. I already paid the interest rate here. Right? I already paid the interest rate here. I cannot make profit. And I didn't suffer any loss. Any more questions? Any more questions? Yes? No, the interest rate is coming from the interest rate is paid by, okay, let me go back. The question here is, because I'm supposed to be recorded here, the interest rate is not paid my pockets, it's paid by the dividend minus $2 interest rate. Then that's dividend. So that $20 has been recalculated because the interest rate paid by the dividend. Good questions. Yes? Yes? Oh, okay. We assume the interest rate cannot change. And that's a very reasonable assumption. Now, the bank, you signed a contract with the bank. That's a 1-year contract. When in the contract, you specify your bank agree is going to pay the interest rate 10%. The bank somehow in the middle of the year tell you, I changed my mind. I want to increase the interest rate to 20%. Are you agree? Okay, so this is somehow that proof that we have to make a compromise in the MBA level. And in this case, we assume the interest rate you bought would be the same interest rate as the debt of financing of the firm. So that's 10%. Yes, we make this assumption. That's the assumption we have to make. That's a good question, okay? Let me know whether everyone is comfortable with this. Yes?
So the dividend for sell position from firm L is like opportunity cost. So finally we didn't get the revenue. Because I think there are something left for the dividends for buying the position from you.
Which one is left? Give me a number. I know exactly. Coordinates. Give me the coordinates. Is that $1, $0, $3, $4? Give me the number.
Total dividends of buy position for extension of page 3. So we calculate the exact return.
No. Total dividend to share is $6 if it's in expansion. $5 is okay. And $2 is in recession. That's black and white, isn't it? There's no argument on that. Why? Because you didn't change in here. You didn't, we assume you didn't change of the capital structure will not change the real investment policy. That's assumption we have. So whatever you change, you cannot change the cash flow. That's the assumption we have. Good questions.
On the other slide.
Next one or previous one? Next one.
Like a year from today, you're assuming that the market price for the shares remain the same at $20.
I don't need to assume. I have to, based on the evidence. So the evidence here is, you don't need to assume. After 1 year, this is the price you have. The dividend, you can think about value, that's coming from the perpetual discount cash flow model. You value the firm per share, you value the firm by the company, right? So the dividend, as long as dividend is paid, all the cash flow is paid out on the dividend, you can value what's the value of each share. So we value it, we don't assume. It's perpetual, right? Good question. That's a good question, yes. I want to iron out all these wrinkles, and the more wrinkles you have, as long as I can iron out, the harder is the impression. Once you get this understanding really, really good, and you will be much better positions. Because this is most likely people want to test your understanding on the corporate finance. I would say on the other side of the table during the interview, that's the first question I could test how deep the water is, the understanding of this, during the interview process. It's very easy to test you. It didn't work, or?
Yeah, sorry, I'm just checking when the mic's worked.
Oh, no, I think the macro worked very well, okay. Everyone is happy here? Nobody left behind, okay? This is the one I want everybody to feel comfortable. If I see no one raise your hand in this classroom, I'm going to take a break, even though it's much longer. 2 hours. Okay, everybody's comfortable? Let's take a 10 minutes break. We deserve a 10 minutes break. We come back in 10 minutes, okay? I really need some water.
One, two, one.
Okay. Once again, any more questions? Because once you ask the questions, I know where is exactly that there is some wrinkles over there. You have to get from the beginning to the end is as smooth as possible. Once you get as smooth as possible, then you feel this is really, really good. This is really, really good. Okay? So I'm not push how much we could understand in this lecture, but I want you to understand that this is the first leg. There's a second leg with tax. Based on this, we'll calculate what's the cost of equity. Okay, that I go relatively quick. And after that, we take tax into consideration. And the tax is going to totally change the picture. And with the tax, what's the cost of equity as well? Okay, and what's the cost of benefit of cost of using debt? So actually, this one, I think it should cost like 2 lectures to be students to get to fully appreciate all this. 2-3 hours, should be 2-3 hours to get to fully understand. But within this limited time, because this is the first time for most of the students understand the Modigliani-Miller theory, and the first leg is the most important thing to understand. I don't want the other classes come again to correct your understanding on this one. I wanted the first one, when you build it up, it's in a very solid, healthy, and productive way. Okay? If there's no more questions, I'm going to move on. And if you have questions, please come to my consultation time. Because consultation, face-to-face discussion, is much more efficient than writing emails. Okay? Everyone's happy? Everyone's happy? Yes. Okay, I heard yes. Okay, let's move on. I'm going to keep these two later on in the lecture when I upload it in Friday, okay? Because this one, I think, is help you to understand this position more. So let's arrive to the conclusion. It's Modigliani-Miller theory, proposition 1 is under 3 conditions: no tax, no information asymmetry, no transaction cost, and the capital structure does not really change the real investment policy. With the 3 conditions, you change the mixture of the debt equity financing, which is referred to capital structure, does not affect the firm's cash flow. And once the firm's cash flow is fixed, the firm's weighted average cost of capital is fixed as irrelevant to the mixture of the debt and equity. Therefore, the leverage will not change the firm value. We know the cash flow firm value is the cash flow divided by discount rate. In the perpetual, let's say this is a perpetual case. Okay, right now, let's move to the second proposition. Modigliani-Miller theory in the second proposition is the cost of equity referred to as ordinary share, common share, increases as the leverage increases. So what does that say is an increasing in leverage, which means you have relatively more debt compared to equity, is going to have some results on the cost of equity. It's going to increase the financial risk of the firm. Increase from what? Increase from the 2 elements, which is, first of all, the cost of equity of the unlevered firm, although it will be the same, but there is additional part. The additional part is the risk premium. As a consequence, this shareholder would expect higher return for their investment in a levered firm compared to an unlevered firm. So what does the proposition 2 in the Modigliani-Miller theory says is, under the perfect world, the government doesn't tax us entrepreneur at all. No tax, no transaction cost, no information cost, and also change of the capital structure does not really affect the real investment policy. And in this case, if the firm increase its debt ratio proportion compared to the equity proportion, the equity holder would require higher return. And for the sake of, I don't ask you to do the derivation in this level. Okay, I just want to show you that a few series. We start from where? This is what we have already learned in the lecture. So this is coming where? This one. Lecture 7. Weighted average cost of capital. I just borrow that one, rephrase to fit into this lecture to be consistent with the textbook. Okay? Then, by the Modigliani-Miller theory proposition 1, we know that weighted average cost of capital, this is for the firm. It's called a firm. Is equal to the K or kappa. If it is a K, that's English. If it is kappa, this is Latin, okay? If it is a kappa here, OS, ordinary share, underscore U, unlevered firm. Unlevered firm. Is firm weighted average cost of capital is equal to cost of equity in the unlevered firm. That's coming from, this is coming from MM1. This is coming from MM1. And this is coming from lecture 7. So I'm going to erase this part. So what we have done, we don't do anything new here. Okay? This part, lecture 7. This part, MM1. And let's put this together and let's see what is the cost of equity when the debt ratio increases, okay, or decreases. So we have these 7 notes here, okay, to make the students more easy or easier to understand. Please note that kappa OS underscore U serves as the same meaning as kappa assets in the textbook, but it's probably better for students to understand intuitively why. That's the cost. We have to differentiate right now. What is cost of equity, cost of capital for the entire firm, and cost of equity in leveled or unleveled firm? So cost of equity has different meanings. If it is unleveled firm, cost of equity in unleveled firm would be equal to cost of equity, weighted cost average of the firm, because it's unleveled. It's full equity finance. So cost of equity would be equal to cost of the firm, weighted cost of capital of the firm. But in the leveled firm, that's slightly different, okay? So that's what we're going to see. Cost of OS, ordinary share, is the cost of equity in leveled firm L. Okay, so this is, I try to emphasize this, and let's go on. I could ask you to do this, I could put one slide show the derivation from this part. I'm going to get this part. I could do one line, one page derivation. I could write this one. Okay? I don't know. You could do that by yourself if you're interested. If you're not interested, and just remember this formula. That's fine. The main purpose is to remember the meaning of this formula. Why? Because again, in the future, it's either you're going to use this one, so you can take this formula, even if you forgot this. You Google search in the future, in the work, you can get this formula. Okay? You don't need to do the derivation. Of course, if you can do the derivation, that would be super. But if you don't do the derivation, that's okay. If you're going to use this one, or in the interview, if you ask about the cost of capital in a leveled firm, you have to remember where is the risk coming from. Okay? So what exactly is cost of capital? The risk coming from two resources. Okay? Is the cost of equity in leveled firm. So the cost of equity coming from resources 1 and resources 2. So it's resources A plus resources of B. In the leveled firm, cost of equity coming from the two pieces, A and B. The piece A is the cost of equity in unleveled firm. Has to remember, this is an unleveled firm. Asset, that we said before, asset is equal to cost of ordinary share, which is equal to the kappa ordinary share unleveled firm. So that's pure equity financed firm. That's how the textbook used the assets. Okay? Because we use Modigliani-Miller theory 1 proposition. But there is a second part. The second part coming from where? Coming from the derivation that I ask you to do in the red square here. Okay? If someone is good in the algebra, you do a little bit of manipulation, you're going to get this one, the page 21. You can see here, let's focus on, right now, let's focus on, let me erase all this, only, this is A, this is B. Let's focus on only the B part. Cost of unleveled, this one is equal to kappa OS. Unleveled equity. That's for sure, it has to be fixed. You cannot change anything. This is fixed. Cost of the debt in the current stage cannot change. So these are fixed. So this is a fixed. Let's say value of ordinary share is not going to change. But you can change what? You can change how much debt you're going to borrow, right? Once you increase the debt level, what about the couple of the assets? This one, the fixed 2. You can see that? If you increase the debt in a leveled firm, in a leveraged firm, cost of equity must to increase. That's Modigliani-Miller theory, proposition 1 in the word without tax. And it's a direct linear relationship. How much you increase the debt, how much the equity holder should require the higher return. Remember, why we're talking about the weighted average cost of capital, the whole lecture number 7. And we're talking about, remember the last question we're talking about in lecture 7 is there is a project that originally deliver 14% return, but it's a new project delivers 70% return. But if you go to the bank do not agree to issue the loan for that project. Your option is to issue the equity in the market. And remember, bank asks for no more than 10% interest rate. If you issue the equity in the markets, how much is the return? How many of you can still remember that number? Lecture number 7, last example. Consider 2 projects, the same company. The second project has potential IRR equal to 17%. First project is a printing project with an IRR income of 14%. Remember, right? Issued equity is 18%. So cost of equity is higher, and it's coming from there. If you borrow more, cost of equity has to be higher. That's why financing the project with the cost of capital would usually be much higher than cost of debt. Why? Because you have more debt in the company and the cost of capital. The minimum here, as you can see here, is unlevered equity. Unlevered equity. You always go ahead as long as you increase anything about the debt. From the zero debt financing to more debt financing, the cost of equity has to be increased. And that's also very, very important. Okay? No question. As long as you're understanding these 2 is good. Okay, so there's an interview question here. In Modigliani-Miller theory, without a tax, in a leveled firm, tell me where is the risk sources of cost of equity. What I'm expecting the answer? The first sentence, the best one, okay, the best one I'm expecting is, there might be 2 resources. Okay, this is going to make the comfort the interviewer on the other side of the table. It's getting into the right direction. There might be 2 resources. The first resources is coming cost of equity in an unleveled firm. It's very nice. But there's a second piece. The second piece coming from where? Coming from leverage risk premium. You put more leverage, you put more debt in this firm, the cost of equity in this leveled firm has to be higher. Okay? So that's how we explain this. You can see how much is the debt here. This is, I specifically, my added here is this part. Cost of assets is equal to cost of ordinary share, OS, ordinary share, in the unleveled firm. U is unleveled firm. Okay? Of course, the debt is going to be, this is the general formula. Because there's a debt is equal to 0. So this part totally disappeared. The first piece, right? What is, as long as you increase, see this one? Debt to equity ratio increase. And you're going to see that cost of capital, this is cost of capital, is going to increase. Okay? Okay. And this coming from the premium of the financing risk is purely coming from is leverage of the debt. The business risk, which is defined by the textbook, is unleveled equity. If you unlevel the equity, that's your cost of equity. But if you put more debt in the firm, the more debt could come in from any number larger than 0. That's more debt. That's your financial risk. That's a risk premium. That's all I'm expecting you understand on the proposition 2. No derivation is required, but you have to understand cost of equity is equal to 2 pieces. First piece is cost of equity in the unlevered firm. Second piece is you put more debt in the company, your cost of equity would be higher. That's the 2. Very straightforward. I want you to understand, okay? Okay. Now let's move into a 5 year later. 5 years later. Modigliani, Miller published the second paper, and it's called 1963. They propose significant advance. They say, no, if the tax is not in the world, it's very unrealistic. But it's a good start, as we don't understand anything here. If the government is going to tax the entrepreneur, which is true in the real world, how proposition 1 and proposition 2 will change or not change. If change, how is it going to change? So that's what the Modigliani-Miller theory, proposition 1 and 2, in the world that we have tax. But if we have tax, then we have another counter effect to the government tax policy. First of all, that's a bad effect. It's a negative effect. Is revenue generated are subject to corporate tax, which is taken away by the government. And as an entrepreneur, somehow we don't like that. Okay? But the counter fact for that is, because government is going to tax me, so what I try to do is try to pay as less tax to government as possible, right? That's a basically counter effect. How I can do that? I borrow. If I borrow, how I'm going to reduce the amount I'm going to pay tax? Think about the EBIT, right? Earning before interest and tax. Tax is going to count after the interest payment has been made. So that's my positive effect on the reduction of tax payment. If the firm borrowed that, the interest or the payment to the debt holder is tax deductible. Okay? And we still hold to other conditions, which is a market condition are perfect. There is no asymmetry information, no transaction cost, change of the capital structure is not going to change real investment policy. Therefore, the value of the firm is going to change. And there is only one direction to change. Is the value of the firm is going to increase if the firm is going to borrow. From full equity, only equity financing, as long as you increase the debt in the company's capital structure, if the government is going to tax on the entrepreneur, which is the true case in every country, even like a tax haven, Bermuda, Bahamas, Hong Kong, Singapore, those are very low tax area, 10%. Coming from Hong Kong, 10%. Here, 30%, 35%. So as long as you charge the tax, the entrepreneur has a way that the value of the firm could increase. At least you got value of unlevered firm, and then what's the extra value you can get? is equal to the tax rate and how much the corporate borrowing you're going to borrow. It's very simple, very straightforward. Okay? How do I prove that? This is understanding here, because I have a limited time here. I was supposed to be conclude in 50 minutes. I have quite a big thing to talk about. So this one is going to show you that firm value, it's almost a similar chart as we discussed in the very beginning. But the key point here is, remember, firm value would increase the firm value. As that increases. You see that this blue in the left-hand side, the blue piece, which is equity, is the largest one. And it gets smaller, and the firm value increase and increase. As long as you reduce the capital structure, you see that that's a huge jump. In the Modigliani-Miller theory without a tax world, capital structure really irrelevant to the firm value. Right now, in a much realistic world where entrepreneurs are subject to government tax, firm value could increase. You don't need to do anything else. Just change your capital structure. Borrowing more debt. Your firm value could increase. Right? This is Modigliani-Miller theory with the corporate tax. As you can see, this point out a very straightforward method to all the entrepreneurs. If you want to increase your firm value, of course you can invest more equity, but that's not the most efficient way. Why? Because without investing more, by just change the capital structure of the firm, when you will be taxed, which is a sure case in the real world, you can increase your firm value. And they can tell you how much exactly you're going to increase the firm value. The higher the tax rate, the more you borrow, actually, the higher value of the firm. How do we get that? Well, I can show you a very simple example here. There is an unlevered firm, which is U. There is a levered firm, which is L. Both the EBIT are 1,000. Unlevered firm, because there is no leverage on that, therefore the interest rate is 0. There is a levered firm, borrow is $4,000, let's say at 10% interest rate, therefore you need to pay $400. Therefore, earning before tax is equal to, for the unlevered firm, is 1,000. For the levered firm, 600. Corporate tax, so that's 35%. Same in the US and Australia. You have to pay 350 for the 1,000, and you only pay 210 for the 600. Net income, 650 for the unlevered firm, 390 for the levered firm. How much to the shareholder? Assume the same assumption. All the revenue are paid as dividend to the shareholder. Therefore, the shareholder of the unlevered firm gets 650. Shareholder of levered firm gets 390. However, remember, right now, when we're talking about investor equal to bondholder and equity holder. Therefore, plus 790. Right? So 790 is significantly than 650. Where does it come from? Come from the next page. Okay. Operation income for the levered firm, unlevered firm, or perpetuity. Okay? Why? Because we still hold the assumption change of the capital structure does not change the real investment policy. So they're the same. Therefore, cash flow are the same. Cost of capital has to be the same. Let's say 10%. For the value of the unlevered firm, therefore, is equal to 6,500. How do I get the 6,500? Level of value of equity, this is the value of equity unlevered firm, is equal to 650, which is coming from the previous page here, 650, and divided by, because it's perpetuity, right? So perpetuity discount rate, 1.1, 1.1 to the power of 2, all the way. And in the perpetuity formula, that's dividend each year divided by discount rate, cost of capital, 6,500. What's the value of the debt? This is the value of debt. Zero, because they didn't borrow. Value of the unlevered firm will be totally different story. Why? It's equal to 3,900 plus 4,000. Let's see how does it come from, those numbers. 390 come from where? 390 come from here, page 26, right? 390 cost of equity is equal to 10% divided by 10%. Because in perpetuity, we have this formula. So cost of equity, 3,900. How much is cost of the debt? Value of the debt is same thing. $400 coming from where? $400 coming from here. Page 26. And 400 is the same way perpetuity. We have the perpetuity formula. That's 4,000. So 3,900, 4,000, that's 7,900. What's the difference? Difference is equal to 7,900 minus 6,500 equal to 1,400 $. How do I calculate the 1,400 in another way? It's coming from the tax, right? And the interest for the payment, cost of the debt. So this is a 400, which is coming from the debt payment interest times the tax rate, and it's in the perpetuity model, right? So this is equal to what? 400 times 35% of the tax rate discounted by the discount rate, and we use, again, the perpetuity save us a lot of trouble here, and we get it 1,400 come from. So it's very simple. T times T. Tax rate times how much you borrow. Okay? So the Modigliani-Miller theory, when the property tax coming from, the value of the firm is actually going to increase. Remember this one. Without the tax, firm value will be stay the same. With tax, with corporate borrowing, the firm value will increase. The more you borrow, the firm value will going to be much higher. Okay? That's very simple, very straightforward. Okay, someone would going to say, wow, this is very good. As an entrepreneur, what's your very intuitive reaction to this one? every entrepreneur, in the deep of their heart, is try to make the firm larger. Every, believe me. Okay. Of course, you can put more equity in, right? But Modigliani-Miller theory told you there is a more shortcut here. Because we live in a world with tax. As long as we live in a world in the tax, the good way to increase your firm value, given the tax rate is fixed in each country, we're going to borrow more, right? See this one. See this one. We're going to borrow more. We borrow more, the firm value increase more. Then what happened? And you're going to find out here is the cost of equity in the leveled firm, cost of equity in a leveled firm is not increased that much compared to cost of equity in a no-tax world. I put it here. Cost of equity in the leveled firm without tax. That's the risk part. That's the second piece, remember? That's a piece B here, remember? Compared to the MM theory with corporate tax. Cost of equity, this one would equal to, with each other, this piece, there is extra piece here, you see that? If you increase the same amount, I on purposely put the two arrowhead here. You see that one? The cost of equity here would going to increase, that's two arrowhead. I'm purposely doing this. For this one, just the one. Why? Because there's another one, it's going to reduce this one. Tax rate is a positive number, and you are times a factor which is less than 1. So your second piece will be smaller than the first piece. So you see that? Okay, I'm supposed to conclude, but I want to give you a last 2 minutes concluding. I leave the rest of the slides for the students to read. And I'm not saying it's unimportant compared to the one that I spent almost 3 hours. It's much less important. Okay? Both for in the future in terms of interview and also for example, the final exam. But one thing you have to understand here. Right now, Modigliani-Miller theory told you that in the tax world, because interest payment is tax deductible, firm value could increase with the more leverage, and the cost of capital will not increase as much as in the world without a tax. So what's the equilibrium here? What's the entrepreneur will do? They try to increase the debt borrowing as much as they could, right? You increase the debt borrowing, firm value increase the same level, cost of equity, of course, is going to increase, but in a slower step. That's because tax deduction. So there is a cost of capital increase with that. So 30 to 33 pages, all these are talking about cost of when you use more debt, what kind of a cost you are going to have. And the first cost is insolvency cost. Because otherwise there's a free lunch in the world. There's no free lunch. Because the more debt you're going to use, you're going to incur the insolvency cost. How to understand the insolvency cost? Let me go back. So that's why I have to put this economic scenario. Remember this one? Page 12. Flip back to the page 12 here. right now, we are assuming the capital structure 50% debt, 50% equity. The interest rate 10%. And if the economy is in recession, this firm is actually in the edge of bankruptcy. Because the interest rate has totally paid, all the revenue has to pay the interest rate. You have cost of earning. How do you pay that? You cannot pay. Once you cannot pay, you're insolvency. And this number, it didn't change when the economy is doing either good or expansion or okay or recession. You borrow too much, you put yourself subject to insolvency cost. That's the most important one. And insolvency cost, we have a direct and indirect if you want. Because this one, I tell you, this is a huge literature. It's a huge literature in the academic world. People spend 20, after Modigliani-Miller series, 60, all the way, even I was a PhD student. There are thousands of papers in this area. I don't think this one could be fully, thoroughly taught within 3 hours. I would suggest the next semester is I'm going to take this one. I'm going to talk about 6 hours. 6 hours. It's a very elegant way to teach everything in very detail. It's because this is the most important one.